Mike, is it all about earnings and earnings coming in big?
I think it is. Yeah, I agree with what Tobias just said. First of all, I think to markets to re-rate higher, we would take an awful lot of really good news outside of the earnings side. And we may not get that, especially as the Fed goes through the process of rate and balance sheet normalization. And you still have some geopolitical hotspots around the world. So I do think what's going to be required for equities to go higher here is going to be earnings. Now, fortunately, what we're seeing now is coming off yet another quarter of solid earnings growth, obviously not as good as the last two. But I think the earnings momentum going in 2018 is pretty strong. We're actually looking for earnings up about 8% or so next year. By the way, that's if we get no tax reform. If we get tax reform, we could see earnings up certainly double digits. Could be as high as 14-15% earnings growth.
So what does that translate for the S&P? Because you have Keith Parker over at UBS. He's 3,300 if we do get a 25% corporate tax rate. Are you that bullish?
We're not that constructive. Look, I think a lot of things would have to go right to get to 3,300. We're a little more cautious on it. We do think there's certainly further upside. We certainly think you can get high single-digit gains in U.S. equity markets next year. But look, if a lot of things break right, if you happen to get, if we're underestimating the earnings growth because perhaps the benefits from tax reform are even more than $10 a share, which we're currently building in, then certainly there's upside to that. And by the way, I'm not dismissive of the market surprising us to the upside. As many of us walked into 2017, we walked in with a lot of uncertainty. There was a lot of policy uncertainty, political uncertainty, yet markets marched to new highs.
But you know what was there? Buybacks. Buybacks were so strong, and now we're getting word that perhaps they're going to roll back a little bit, perhaps. Companies are going to spend more on CapEx, not buybacks and dividends. Does that remove a substantial support to the market, or is that a good rotation?
Well, first of all, I think it's healthy. First of all, if companies are willing to reinvest in their business, that's usually a sign, an indication that that they have a better outlook for the future. I'd also be careful because, remember, to the extent that tax reform does pass, and we do get an ability to see repatriated earnings back to the U.S., that'll be deployed many ways. Some of it will go into CapEx. Some of it will certainly go into M&A and mergers and acquisition. But I think a fair amount will still go into share repurchases and also dividend growth.
Do you want it to go into CapEx?
Well, it depends. I mean, I don't want to just simply arbitrarily report into capital spending. But remember that we've seen in terms of business investment spending has been historically low throughout this economic expansion.